Have you ever been interested in how taxes affect your or your client's real estate closing? Well, today we're going to talk about all the different taxes and how they play a huge role in our closings, either before, during, or after. So the first type of tax we're going to talk about is transfer taxes. If you've ever had a deed, you've definitely paid transfer taxes if you paid money for that property. Here in the state of Michigan, our Michigan compiled laws actually tell us how we have to pay transfer taxes. So the first thing we want to note when we're looking at transfer taxes and the way that those work is basically that we have to pay transfer tax based on the value of the property. So it's the total value of the property being transferred. It's not the amount of money that we're writing on a deed, it's the actual value. So if you've ever heard of this fancy phrase called a real estate transfer tax valuation affidavit, which I lovingly refer to as a RETVA, it's this nifty way where we can actually avoid writing the consideration on the deed. So if you have a client who maybe doesn't want everyone to know that you spent $500,000 on this property or $50,000 on the property, instead of writing that consideration on the deed, instead you can file a real estate transfer tax valuation affidavit. And that goes to the Register of Deeds along with your deed. And in order for us to figure out how much transfer tax we have to pay, we don't look at the deed, we now look at our RETVA. So when we're calculating transfer taxes, it's relatively simple until it's not. So there's two main types of transfer taxes that we're going to pay. We're going to pay state transfer tax and county transfer tax. So of course, no surprise that state transfer tax is a little bit more than county transfer tax. And of course, we're not going to make it too easy, okay? We're going to calculate it based on $500 intervals. So you're always going to round your consideration amount up to the closest $500. So if you sell your property for $100,000, that's great. And we don't have to do any rounding. If you sell your property for $100,001, we have to round that up to $100,500 and use that number for our calculation. So that actually works out to about 3/4% if you want to just multiply that rounded number by something simple. You can take $100,500, multiply that by 0.75, and that'll tell you how much state transfer tax you have to pay. And so for county transfer tax, that's a little bit less expensive. That's actually 55 cents per $500, which works out to about 0.11%. So you can do that same thing, take that rounded number, multiply it by 0.11, and that'll get you your transfer tax. So that means in total, we're paying $4.30 per $500 of consideration. So you're going to round up to your 500 and multiply it by 0.86%. And that'll tell you the total amount of transfer tax that you need to pay. So for example, if you've got a sales price of $550,000, your state real estate transfer tax is going to be about $4,000. Your county transfer tax is going to be $605, and that means your total is $4,730. That's kind of a big deal. So we definitely want to pay attention to transfer tax and remember that this is a really important and integral part of our closing. We want to make sure that we're preparing our clients appropriately. And it's also an important thing to remember that most purchase agreements in the state of Michigan also require the seller to pay this fee. So this is something that the seller is usually going to be paying. So the next big section of property taxes, and this one is very near and dear to my heart, is when we're actually talking about genuine property taxes. And we all tend to get a little bit flustered because there's a ton of terms that get thrown around whenever we're talking about property taxes. We hear the terms SEV and TV and capping and uncapping, and oh my, what are we talking about? So the easiest way is let's start with what we know. we know true cash value, right? So we know our property is maybe worth $100,000 or $150,000. And when we're talking about property taxes, we're going to start with a true cash value as well. Now, your taxing unit is going to determine what it thinks your true cash value is. And that's just based on studies over the past few years. They're looking at market sales, things like that. So it's not going to match necessarily exactly how much money you bought the property for. But there will be a determination of what they feel true cash value will be. So in theory, this is basically what the municipality has decided that your property is worth, right? Simple number. We're all comfortable with that one. Now we're going to get a little more complicated. So now we start talking about this crazy SEV that everybody likes to throw around. That stands for the state equalized value. Actually, this is a little bit more simple and much less exciting than we like to make it be. So the state equalized value is really just 50% of true cash value. So we're going to just take that true cash value, we're going to divide it in half. And with that state equalized value, we're also going to find taxable value. But here's the difference. Taxable value will always be the amount that your taxes are based off of. Okay? So your taxable value will be used when we're calculating your actual taxes. Now, taxable value isn't going to change very much. In fact, there's actually some limitations. Each year, your taxable value can only increase a maximum of 5%. And it's going to increase with inflation. So if the inflation is 6%, it's going to be capped at only increasing by 5%. So if your property went up 10% in value, great, congratulations. That's a good year for you. But don't worry, your taxes aren't going to go up 10%. They can't. They're capped at 5%. So when the municipality reassesses and they look and they say, oh, Caitlin, your property value has gone up so much. They're going to raise my true cash value. They're going to raise my state equalized value, and they're going to raise my taxable value, but it's capped. It's capped at 5%, and that's the most it can raise. Now, geez, we know the terms. How in the heck are we going to figure out exactly how much I owe? Well, it's actually relatively simple. We also hear this term mills thrown around. And in very simple terms, 1 mil equals $1 per $1,000 of taxable value that we're going to pay in taxes. So what that means is if your taxable value is $100,000 and your taxes are 30 mils, that means that you owe $3,000 in taxes. Very simple. Okay, you're going to take that millage rate of 30 and multiply it by the number of thousands you have, which is 100. 30 times 100, 3,000. Easy math. Unfortunately, not always that easy, but today, for our example, we like it. So now the real question. We get to the crux of the issue. If I sell my house, how will my property taxes be affected? You know, it's nice to know about property taxes, but I need to know this house I'm looking at, are my taxes about to skyrocket or are they going to stay about the same? And we definitely need to know what's going to happen in the near future. So there's a few different ways that we can do this, right? But the first thing we have to understand is that every year as inflation increases, and our taxable value increases and it's capped at 5%, there's only that cap on the increase while the same person owns the home. So if that property goes and gets sold and someone else buys the home, what's going to happen is something called uncapping. So at the time of the sale, the property is eventually going to be reassessed. That true cash value is still going to exist. That state equalized value is still going to be 50% of that true cash value. But now the taxable value isn't stuck way down here. The taxable value is going to come up to match the state equalized value with that sale. right? So when you sell the property, what's going to happen is you're going to see that taxable value come up to match your state equalized value. And remember that taxable value is what we're using to calculate taxes that are actually owed. So what's a really quick and easy way to look at maybe the seller's tax bill and see, how much are my taxes going to change? You can do a simple quick look at the SEV and the taxable value. Okay, so if you see that SEV is way up here and that taxable value is way down here, you know that when this uncaps on sale, what's going to happen to that taxable value? It's going to come all the way up here so that it matches. So if you're seeing a huge discrepancy between SEV and taxable value, then you know the taxes are going to be very different, aka a lot more, after the closing, okay? So that's a very important thing to look at, an important thing to remember. And also, this is a great friendly reminder. If we see that our SEV has skyrocketed, even on our personal taxes, we don't need to panic, right? Because our taxable value can only increase by 5% so long as that ownership is staying the same. There's also a really cool resource that I put here for you guys. It's a great tax estimator. So it will allow you to estimate what your taxes will be. Now, another fun thing we have to talk about with property taxes is what happens when they're unpaid. So we talk a lot about mortgage foreclosures, which fortunately we're not seeing very many of right now, but there's also this concept of tax foreclosures. So if we don't pay our property taxes, the state, the foreclosing governmental unit, which could be the county, can actually come and foreclose that property because you haven't paid your property taxes in 3 years. So as a reminder, we're always going to make sure that we pay our property taxes, of course, but we pay them to the municipality until they become delinquent. And the state of Michigan tells us that they are delinquent following after March 1st if they're still unpaid. So if your summer taxes and your winter taxes are not paid, the following March 1st, they now become delinquent. Why does this matter? Because now we have to pay them to the county instead of the municipality. But also, there are some really, really, really fun fines that get added. We want to avoid those, right? There's also one other complexity with our closing that we have to think about as well. And a lot of us don't even realize, but every single time we record a warranty deed, we're paying transfer tax, remember, but also we pay a little bonus $5 to the Register of Deeds to do what? They're going to actually tax certify that deed. And what it means is they're actually going to do a little bit of research and make sure that you've paid your property taxes. So what does that mean if you haven't paid your property taxes and they are delinquent, aka after March 1st, you can't record that deed. We have to actually pay those taxes and make them current before that deed can be recorded. So it definitely adds a little bit into our timeline, and we have to be very, very careful. We got to be really careful that we're not trying to squeeze things in too tightly if we have taxes that are categorized as delinquent, meaning not paid until after March 1st. So not necessarily a huge, huge problem for our closing, but definitely something we've got to think about. Now, our favorite thing when it comes to property taxes is the principal residence exemption. And why is it our favorite? Because it means we get to pay less taxes. And of course, Michigan compiled laws, they're going to give us a lot of rules. They're going to tell us when we get to claim this exemption, all right? Because we are given a list of all the things we owe taxes for, and everything is going to have, you're going to have a line item for each thing you owe taxes for and a millage rate to match that, all right? However, in the great state of Michigan, we are allowed this thing called a principal residence exemption, where on our one principal residence, we are allowed to make this exemption where we don't pay up to 18 mills for our school district operating taxes, which is amazing. So on our one property in the state of Michigan, the one we are claiming as our home, right? That's the property we're allowed to claim our principal residence exemption on and get that little tax discount. So that's 18 less mills that we have to pay. Now, there can be some complications with principal residence exemptions. So sometimes if we see that a property has changed hands a ton of times, especially maybe between investors or LLCs or something like that, there's going to be this thing that's called a PRE denial. And that means that maybe someone claimed a principal residence exemption, but they didn't actually qualify for it. And so what's going to happen is after the state does their homework, they're going to say, whoa, buddy, you claimed this exemption and you paid 18 less mills in taxes, but that was not correct. And now you owe us those taxes that you didn't pay because you didn't really deserve that principal residence exemption. Okay, so first of all, we want to make sure that we're doing this correctly because we will still owe those taxes down the road. But second of all, if we're involved in a real estate transaction and the seller claimed that principal residence exemption, but they shouldn't have, we, as the buyer, might actually end up with that tax bill, which is super scary. We don't want to pay for the seller's misdeeds, right? We definitely don't want to pay the taxes that they neglected to pay for however many previous years. So that's where we come in with this thing called a bona fide purchaser. And what we do as the buyer is we say, whoa, we're the buyer. We did not know about the seller's misdeeds. We're a bona fide purchaser. We genuinely are reporting our taxes correctly, and we were not made aware that the seller made this oopsie in the past. And therefore, those past taxes should be passed along to the seller and not stay attached to this property that I now own. Now, there's some really great forms on the Michigan State website that you can actually utilize for these. Also, feel free to give us a call and we can help you with those as well. So, we really can't be done talking about property taxes until we cover property tax prorations. And this is also one of those kind of mystical things that we never really spend a whole ton of time learning, but geez, they are in every single transaction that we handle. Well, they're in almost every single transaction we handle. Now, first and foremost, what the heck is a property tax proration? So in the state of Michigan, most municipalities and counties, we've got two taxes that we pay every year, usually one in the summer and one in the winter. And when the seller pays those, they're either paying them forwards or backwards. But when it's time for a sale, the buyer and the seller are going to come together and determine who needs to recoup the other person for taxes that are going to be paid or have been paid by the other party. So what we're trying to do initially is we've got to figure out our taxing and billing cycles for the municipality that we're in. So for example, if our municipality's billing cycle is what's called advanced, that means that we're paying forward. So if I pay my taxes today, July 1st, I'm paying for my taxes for July 1st, 2024 through June 30th, 2025. I'm paying them in advance. Okay? Now, if my municipality doesn't do it like that, if instead we pay them in what's called arrears, it means when I pay my taxes today, July 1st, 2024, I'm actually paying them backwards. So I'm paying for a tax period from today back through July 1st of 2023. Today's 2024, I'm paying backwards to 2023, okay? So we first have to know, are we paying taxes in advance or are we paying them in arrears, right? Now, the second thing we have to know when we're working with tax prorations is actually the method of proration. So we're gonna figure out how many days during the billing cycle the seller owned the property and the buyer owned the property. But how are we determining that cycle, right? So there's two different cycles we can use. One is the calendar year. Hello, January through December. That's easy. We know that one, right? The second one is due date basis. That's where we're going to use the actual due date of each tax. So for instance, we've got July 1st through June 30th. So our dates that we use will be July 1st and June 30th. Or if we're paying the winter tax, we've got December 1st through November 30th. So we'll use December 1st and November 30th. That's due date. Now remember, calendar year is different. Calendar year is January through December. Due date is the actual due date. So we technically have 4 different ways we can prorate, right? Advanced based on the calendar year, advanced based on the due date, arrears based on the calendar year, and arrears based on the due date. So we've got 4 options. Now, many of us are in the Tri-County area. We're in Wayne, Oakland, Macomb, Washtenaw, Genesee, Lapeer. Those are going to be in advance on a due date basis, okay? So we'll do an example there. If you're on the west side of the state, you're in Lansing, you're gonna do it differently, but the concept works the same, okay? So, for instance, if we have a closing date of February 1st, 2024, now we're going to prorate in advance. So that means whenever the seller paid his taxes in 2023, he paid those taxes forward. He paid them in advance. So when we sell the house on February 1st, the buyer is getting this house with the taxes already paid, right? And they don't have to pay taxes for a little while. So we know because he's paying them in advance, we're actually going to have a credit from the buyer to the seller. Buyer's going to repay the seller because the taxes were paid in advance, right? And remember, if it's in arrears, it's the opposite way. But right now we're going to focus on advance, okay? So everything we talk about for this example is going to be the buyer repaying our seller because it was paid in advance. So now we're also going to do this on the due date basis, okay? So remember, our closing date is February 1st, right? So we're going to prorate based on that February 1st date, and then we're going to run it through to the next billing cycle. So February 1st through June 30th. That time frame is the time frame where the buyer is going to be living in the property, but the seller's already paid the taxes, right? Because the buyer doesn't have to pay another bill until July 1st. So the buyer is going to repay the seller for that February 1st through June 30th. It's going to be very nice for the seller. Going to get a nice little check for that, right? Now we'll do the same exact thing for the winter taxes, okay? So from from February 1st, our closing date, through November 30th, our buyer is again going to pay the seller back for the taxes that they paid while the buyer is actually living in the property. And then of course, come July 1st, come December 1st, the buyer will now have to pay the taxes moving forward. Okay, we are almost halfway there. Thank you so much for sticking with me through property taxes. I hope you learned something new. We are about to go head first into capital gains, and we're definitely going to learn some new things. If you are loving this video, please feel free to subscribe and let's learn something new. So what exactly are capital gains taxes? Long story short, this is the money that you're going to pay to the IRS whenever you make money on the sale of an asset. And because we want to keep things just a little more complex, there's actually two types of capital gains taxes we can pay. There's long-term capital gains and short-term capital gains. So we're not going to focus a ton on short-term capital gains taxes today. Those taxes are the taxes that we pay if we've only held the asset for less than a year. So if we've held it for more than a year, that's what's categorized as a long-term capital gain. Less than a year, it's short. More than a year, it's long. So the reason why we're not going to focus on short-term capital gains taxes is actually because those short-term capital gains get taxed just the same as ordinary income. The IRS doesn't really think they're that special, so they don't get a lot of special rules. We're going to focus on the special ones today. So that means long-term capital gains. So again, capital gain is something where we've sold an asset and we've made money. So let's look at an example. Obviously, we're talking about real estate today, so let's use that example. If I buy a house in 2009 and I buy it for $400,000, let's say I put $25,000 into it, that means that my new adjusted basis is $425,000, okay? That's the amount of money I've put into it. Adjusted basis is a really nice fancy tax word. We just have to know that one. Now, if I sell my home this year in 2024, bear in mind that a lot of the tax brackets and things change every year. So as you're looking at these numbers, always keep in mind that today we'll be looking at 2024 numbers, but that's based on the year that you're selling the asset. So if you still haven't filed 2023 taxes and you sold that asset in 2023, that's a different set of brackets. But moving forward, if we sell something this year in 2024, these are the brackets we're going to be looking at. So if I sell my home and it's $550,000, I'm going to subtract the amount of money I've put into it, which is my net adjusted basis. And I also get to subtract closing costs, which is nice. I'll take it, right? So that means I have a capital gain of $120,000, okay? I bought a house, put some money into it, sold a house, the amount of money I made, that's my capital gain. Now, if I'm a single person and I make $80,000 a year, I'm going to come over here to this little bracket, and it's going to tell me that as a single person making $80,000 a year, I'm going to pay 15% in capital gains taxes. Now, if I make less than $47,000 and $47,026, I'm actually not paying capital gains taxes at all. Yay, that's great. Now, if I make more than $518,900, I'm actually paying 20%. So that's a bummer. I mean, it would be nice to make $518,000, but I'm going to pay 20%. So I know I'm right here in this middle tax bracket. I'm single, make $80,000. So that means I'm going to pay 15% on that $120,000 capital gain. Okay, so what I'm going to do is I'm going to take that 120, I'm going to multiply it by 15%, and that tells me I owe $18,000 in capital gains tax. Boom, easy, we're done. Just kidding, we're not. So what else do I have to pay? Also state capital gains tax, which is the same as our ordinary income tax. So I take my 120, I multiply it by 4.25, because in 2024, it increased to 4.25. So I take that 120, I multiply it by 4.25%, and that equals $5,100. So boom, done. Easy, right? Well, not quite that easy. There are some other fun factors. So I gave you an example with a single person making $80,000. You can see that there's actually a couple of different tax brackets, okay? So there's for married people filing jointly, single people, heads of household, married filing separately, and then also estates and trusts. Everybody is going to pay a slightly different, they're going to pay either 0, 15, or 20% on their capital gains based on the bracket that they fall in. And you'll notice they're all just a little bit different. And they fall in line kind of similarly to how the income tax brackets fall, but they are not exactly the same. So the real question, right? We can do the math. Math's not that hard. But geez, Caitlin, like, when am I actually filing my capital gains taxes? When do I pay them? When do I figure out how much I owe? Like, how the heck does this work in a real estate transaction, right? So you might not even realize this, but the dispersing title company, so the title company that's responsible for handing out all the money, they are the ones who are responsible for telling the IRS that there may or may not be a transaction with potential capital gains tax. Okay, so they're going to have this document. It's called a 1099-S. It's a very specific document. All right, it is a reporting document. And what they're going to do is, on certain transactions, they're going to let the IRS know, hey, this transaction took place. Okay, now, not every transaction, okay? If you've ever seen this really cool document, it's called a certificate for no reporting, yada, 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 yada. And it's got all these really cool questions, true, false. And you're like, oh man, this is confusing. That document is actually helping the title company determine whether or not the 1099-S has to even be filed. Now, good news, bad news. The IRS actually creates that document. So we have to actually use that exact format in our industry, and we've got to take that information, and then we also are going to turn around, figure out what it's telling us, and then decide if we're filing that 1099-S. Now, if you'll notice, that 1099-S form is pretty small. There's not a lot of information on it. What are we even telling the IRS? We're telling the IRS the seller's name, we're telling the IRS the seller's social security number, and we're telling the IRS how much they sold it for. But there's some things that are not on that form, like, I don't know, how much capital gains the seller had. So when we're filing that form, we're really not even giving the IRS a ton of information. We're just saying, hey guys, just an FYI, Bob over here might owe you some capital gains taxes. You'll find out next April. Okay, so what's going to happen next year when Bob goes to file his taxes, he's going to sit down with his tax professional and say, hey, I sold my property. And they're going to look and they're going to figure out exactly how much he had in capital gains. And they're going to look, did he put money in the property? Did he not? How much did he buy it for? How much did he sell it for? They're going to go do that math that we did. Okay, then when he goes to file his taxes, they're going to list on there exactly how much he had in capital gains. And based on his income bracket and everything like that, they're going to determine how much he owes to the IRS. Okay, so that's something that the seller does when they file their taxes. So a lot of times, and this is a really great pro tip for us as realtors, a lot of times we have clients that come to us and they panic about that 1099 at the closing. And they're like, on here it says the sales price and that's not how much I made in capital gains taxes. And they're like, I don't want to pay capital gains tax. I don't want to pay 15% on $500,000, right? And we just need to know, don't worry. That's not what that document is saying. It's just a simple heads up to the IRS. Hey guys, Bob may owe some taxes. This is how much he sold it for. That's all we're doing. Nothing too exciting. So, good news. As with all things in the tax code, there's a lot of rules, but with rules comes exemptions. We love an exemption, especially for taxes, right? So because we have that certificate of no reporting, which means sometimes we don't even have to tell the IRS that a property was sold. And the reason why we don't have to tell the IRS, hey, Bob might owe taxes, is because we can very, very, very clearly see, based on that certificate of no reporting, that he's going to fall into an exemption. Now, if he fills out that certificate of no reporting, we look at it and we're like, you know, we still have to report this. It doesn't mean he doesn't qualify for an exemption 100%. It just means we have to report it and later they'll have to make the determination. But if it's really clear to us at the time, then we don't have to report it, right? So now let's look at what it looks like if we have this exemption. All right, so we're gonna look at basically the same exact example, but now I'm married and I'm filing jointly. We make about $180,000 a year. Same thing, buy it for $400, fix it up for $25. Now I'm in at $425, sell it for $550. My net adjusted basis, remember that was $425, closing costs $5. I'm at my capital gains at $120, right? Now, if we're exempt, I get an exemption of up to $500,000 of capital gains. So am I going to pay any federal capital gains here? No. Yay, we love this, right? This is what we want. Now, unfortunately, we do still have to pay state capital gains taxes, but we don't have to pay that yucky 15%, which is a definite W for us. Okay, so FIRPTA. We've all heard the 6-letter F word, FIRPTA. And that, you know, we're always wondering, what the heck is FIRPTA? Well, it stands for Foreign Investment and Real Property Tax Act. Okay, so this comes straight from the IRS again. Why are we talking about it when we talk about capital gains taxes? Well, we have to understand what the heck FIRPTA is. So FIRPTA was invented by the IRS as a method to ensure that even individuals who didn't live here in the US, maybe weren't US citizens, et cetera, we want to make sure that the federal government still gets their taxes even if this person doesn't live here. All right, so what are we going to do? We're going to create FIRPTA. All right, we want to make sure that we can get those capital gains taxes from everybody, even if they are not a US citizen, even if they're a foreign person. Okay, so the one thing we want to think about, remember, we don't pay actual capital gains. We don't calculate actual capital gains until we're going to pay our taxes, right? And we actually file our tax return. So we have to know the difference between a withholding and a tax, okay? So when we decide, hey, Caitlin owes $50 in taxes to the IRS, that's a tax. But every week when Caitlin gets her paycheck, or every other week or whatever, the IRS can withhold taxes from her paycheck in anticipation that Caitlin's going to owe us some taxes. It's just a guesstimate, right? We're just guessing how much taxes might be owed. So we're going to withhold a chunk. The IRS is going to hold on to it. And then later we'll figure out how much is actually owed. So when we're talking about FIRPTA, we're not talking about an actual tax being determined necessarily. We're usually talking about a withholding. All right, so what the heck does that look like? Well, the IRS determined that it's going to be really important that we can keep track of all of these transactions and make sure everyone pays capital gains taxes. And a lot of times we ask the question, oh, does FIRPTA apply to this transaction? And the answer to that is always yes. FIRPTA applies to every transaction, right? FIRPTA actually applies to every transaction. And the real question is there an exemption to where this FIRPTA withholding doesn't have to be made? So FIRPTA tells us, hey guys, if you have the sale of real estate, you need to submit a 15% withholding to the IRS. Okay, so if there is a sale of real estate, everybody has to submit a 15% withholding to the IRS, right? And we're like, whoa, wait a second. We haven't been doing that, right? Well, that's because FIRPTA also gives us exemptions, okay? So, everybody has to submit a 15% withholding to the IRS unless one of two things is true, all right? First option is that the seller is not a foreign person. We will come back to what a foreign person is. But the first time we have an exemption, we don't have to pay in that 15% off the bat, is if the seller is not a foreign person, okay? Option 2 is that the buyer is using the property as a principal residence and the sales price is under $300,000. So it's $300,000 or less, and the buyer is going to be using the property as their personal residence. Okay, so if it's not one of those two things, seller is not a foreign person, or buyer is using it as a principal residence, and the property price and the purchase price is $300,000 or less. If it's not one of those two things, gotta pay your withholding tax. Usually it's 15%, okay? So the IRS tells us it always applies unless there's an exemption. Now, we have some pretty strict rules about how we have to document the exemption. So have you ever had to fill out some kind of confusing tax forms? I'd be very surprised if any of you said no. But we know that there's a FIRPTA form actually for the buyer and the seller that we can sign at closing that memorializes these exemptions, okay? So our buyers and sellers, well, our buyer or seller has to fill out one of these exemptions. Otherwise, that withholding needs to be made, okay? Now, if there has to be a withholding, of course, and this is going to be a surprise to no one, there's going to be more tax documents that get filled out. We're looking at a Form 8288, a Form 8288A, which by the way has 3 parts, A, B, and C. It's going to be super fun. I also highly suggest if you have a client who might be subject to a FIRPTA withholding, meaning they don't fit into one of those two exemptions, they are a foreign person according to the IRS, right? Or the buyer's not using it as their personal residence and it's, and or it's over $300,000. There are specific companies that can advise you on exactly how to do this process as seamlessly as possible and make sure that we're doing it in a really safe way for our sellers. Okay, because it's ultimately the sellers that are gonna have to take their check and send out 15% to the IRS. So let's take a look at a couple important questions. Number 1, who is a foreign person according to the IRS? Okay, we can very easily see a lot of these designations are what the IRS considers a foreign person. And then we get down to the bottom, resident alien, we do know for sure, is not a foreign person, okay? So a resident alien does not necessarily need to file a FIRPTA withholding. And then we have this great, brilliant scientific test. And it is lovingly referred to as the green card test. If your client has a green card, usually they don't have to pay FIRPTA tax. It's very scientific. Do they have a green card or not? And a lot of people ask me, hey, what does a green card look like? So here's 2 really great examples. They are example green cards. They're not pictures of someone's green card, but that's what they're going to look like. So let's get into more of the nitty-gritty on exactly what FIRPTA is going to look like and feel like, especially for our sellers. Okay, so let's use our same example. Single person, $80,000 a year. Same math, brings us down to $120,000 in total capital gains. We're very familiar with this number, right? And normally I would need to go over and calculate my 120 times 15, and it would tell me how much tax I'm going to pay. But with FIRPTA, that's not what we're doing. With FIRPTA, what we're doing is we are taking that $550, the sales price, and we're multiplying that by 15%, and that's the withholding, okay? I don't care what your capital gains was. Nice math doesn't matter, okay? The IRS says we're going to take that $550, the sales price, that's the number we're using, multiplying that by 15% or potentially 20. And that's going to get us to a withholding of over $87,000. And so our client is going to have to take that $87,000 and send it straight to the IRS. And really, they're never even going to touch that money. The title company is going to take that and they're going to send it straight to the IRS. It can't be held in escrow or anything like that. It actually has to be sent directly to them. So if we have a potential FIRPTA situation, we want to make sure that we address this as early as humanly possible, because our seller probably does not want to just give up 15%. They probably don't want to just send that $85,000 plus check to the IRS. All right. That doesn't really sound fun for any of us, particularly if the seller wants to, I don't know, buy another house. They probably are counting on that money. So that's when we do have some other alternatives, okay? And this first one is called a withholding certificate, all right? Now, the IRS gave us this option to do a withholding certificate, and it was very, very kind of them. They were like, okay, don't worry, you don't want to do a withholding. I totally get it. We'll give you this option to do a withholding certificate. And what will happen is you'll file these documents with us, and instead of us making you do a withholding, we will determine exactly how much money you owe on the front end, and you just pay us what you owe. Sounds like a good idea, but in reality, it's usually not so easy because first of all, you have to already be under contract. You have to have a purchase agreement in order to file for a withholding certificate, okay? And you usually need a relatively skilled tax professional to handle this for you. And the IRS tells us it takes about 90 days, all right? So if your client is dead set on going the route of a withholding certificate where they get a definitive amount that they have to withhold, we probably need to work really closely with our buyers, and we probably need to work really carefully on setting appropriate expectations about how long this closing process is going to take, because most people who agree to buy a home aren't prepared to sit around and wait 90 plus days for our seller to receive this withholding certificate. Now, there is one thing as well. You do need a tax ID number for this withholding certificate. Now, if you don't go the route of withholding certificate, you just want to do the FIRPTA withholding, a lot of people tell us, oh, our client, our seller, myself, I don't have a tax ID number. Now, we always caution everyone, it's best practice to get a tax ID number. Legally, you do not have to have a tax ID number for a FIRPTA withholding. However, let me set the scene. I'm going to send a check to the IRS for Bob Smith in the amount of $87,000. I'm going to send it in February because that's when I sold my house. Now, come April of next year, I'm going to say, hey, IRS, do you remember that time I sent you a check for $87,000? And by the way, my name is Bob Smith. And what do we think the IRS is going to say? Oh, let me see if I can find that Bob Smith and your $87,000, right? Without that tax ID number, it makes tracking those funds really, really hard. So we've got to be really careful. And it's always, always, always best practice to get that tax ID number before we do a withholding. And it is required if the clients decide to go the route of a withholding certificate. Another concept that we usually think about when we're thinking about capital gains taxes is 1031 exchanges. So this is a method, again, the IRS created this, put it into the code. It's actually section 1031, that's where they get their name. It was created to actually allow us to defer paying our capital gains. So instead of at the time of closing, we now have this capital gain and subsequent capital gain liability. Instead, we're actually able to exchange this property for another like-kind property. And instead of owing capital gains taxes now, I don't owe it until I sell that next piece of property. And then I can exchange that one, and then I still don't owe it. And as they lovingly refer to it, as kicking the can down the road. So you can keep deferring those capital gains taxes on and on. The number one thing to remember when we're working with 1031 exchange, or we're even considering a 1031 exchange, is you have to have a qualified intermediary. This is not a title company. This is a separate entity, okay? This entity, they are referred to as qualified intermediaries. They're going to basically run the show. They're going to tell everybody what they need to do. They're going to keep everybody in line. And the title company is going to ask the qualified intermediary for very specific instructions. So if you are considering a 1031 exchange, the number one thing you want to do is find, interview, talk to a few different qualified intermediary companies, and they will help you answer all of your questions. The next thing you want to think about is actually there's a very specific timeline involved. So you don't want to say, oh, I'm going to sell my house tomorrow. Maybe I'll do a 1031 exchange. We want to put a lot more planning and effort into facilitating 1031 exchanges, not just because you need to find yourself a great qualified intermediary, but also because there's some really strict timelines around how these transactions need to take place. Wow, we covered a ton of material today. Everything property tax related. Thanks for sticking through it with me. If you have any additional questions, whether it's about property taxes, transfer taxes, or capital gains, please feel free to send me an email or give me a call. If you're looking for a title company that really knows what they're talking about as far as capital gains, property taxes, any of that goes, please consider using us for your next transaction.